Today's headline is honestly pretty stark. Institutional capital picks ETH, and BTC cracks at resistance. It is July 7th, 2026, and if you are managing a digital assets book today, you have, well, roughly 48 hours to figure out if what we're seeing is just a temporary rotation or a fundamental regime change in market structure.
Right, because when you're sitting on that investment committee tomorrow morning, you just can't afford to allocate a single basis point, meaning, 0.1% based on industry hype.
Exactly. You have to strip away the noise.
We really need to ruthlessly critique and stress test the 3 specific market signals from today's research note, because, if we misdiagnose the underlying mechanics here, the capacity decay on your macro overlay could just absolutely punish your portfolio.
Yeah, let's just dive right into the biggest structural shift first. We're looking at JPMorgan's Jltxx. So this is a tokenized money market fund, and the data this morning confirms it grew its assets under management by 250% in a single month.
Wow, 250%.
Yeah, and operating specifically on Ethereum, the market is pricing this as institutional finance, officially exiting the pilot phase. This is live production-grade infrastructure. It's like a major shipping company finally moving from dirt roads to a paved highway.
Okay, wait, let me push back a second as someone looking at the broader business impact. Why does that actually matter right now?
Well,
because 250% looks incredible on a slide deck, but is this actual sticky institutional capital? Like, is it being utilized as long-term collateral, or is this just a temporary novelty? Because a 1-month spike could easily just be internal balance sheet rotation masquerading as organic demand.
You call it a novelty, but look at the regulatory capital it took them to get this live.
Yeah.
A Tier 1 bank like JPMorgan does not burn through 2 years of intense compliance negotiations just for a 1-month PR stunt.
Right.
The infrastructure commitment is highly permanent.
Sure, I'll concede the infrastructure is permanent. The compliance firewall they had to build is massive. But infrastructure doesn't guarantee liquidity retention.
Yeah.
If this is just a pilot program pushed by one aggressive desk, that data pipeline is going to be completely empty next quarter. You can't build a macro strategy assuming 1 month equates to a permanent shift.
That is a very fair distinction. We have to separate the existence of the plumbing from the stickiness of the capital. But the sheer velocity of that 250% accumulation shows that the demand for on-chain collateral is severely pent up. But look, if traditional finance is laying down this plumbing on Ethereum, we have to look at who was actually buying up the underlying asset to use it.
Right, which brings us to the liquidity side of things. Let's break down the actual size of that accumulation.
Exactly. So Signal 2 is BitMine. They just executed a $73 million ETH buy. But the raw dollar amount isn't really the signal here. With this execution, one single corporate buyer now controls 4.8% of the total ETH float, meaning the available trading supply. The thesis here is aggressive float compression. They are executing the MicroStrategy playbook, but applying it to Ethereum. It's like one developer quietly buying up all the prime commercial real estate in a growing city before the population boom hits.
Help me picture the size of this, because 4.8% might sound mathematically small for a global asset. Does that specific percentage actually move the needle for a macro overlay? Why should an allocator care?
Because it fundamentally alters the physics of the order book. Think of the active trading float like the suspension cables on a bridge, right?
Yeah.
Those cables, the active supply, absorb the market shocks. When one entity locks up 4.8% of those cables in a cold storage corporate treasury, that bridge becomes hyper-reactive to any new weight. You're removing a massive chunk of the asset side liquidity.
I see. So it forces a mechanical supply squeeze, forcing the price up. But wait, everyone cheering for that supply squeeze is totally missing the flip side. Aren't we staring down an existential manager risk?
How so?
Well, if they hold that much of the float, they essentially become the de facto central bank of Ethereum liquidity. You're betting on BitMine's board of directors not panicking. What happens if, their core business faces a cash crunch and the board mandates an immediate liquidation?
Yeah, that would be a localized catastrophe for the bid stack.
Exactly. If they dump even a fraction of that back onto the open market in a distressed state, the exact same lack of shock absorbers that drives the price up will just cause it to gap down violently. You are trusting one entity's balance sheet to not rug pull the entire global trading supply.
And that is exactly the vulnerability an investment committee needs to price into their risk models today. But, this dynamic of intense float compression stands in incredibly stark contrast to the rest of the market. While ETH is seeing this accumulation, the traditional market leader is telling a very different story under pressure.
You're looking at the Bitcoin tape for the third signal.
Yes. Bitcoin has finally stalled at the $64,000 resistance level.
Yeah.
The data here is critical. Bitcoin just absorbed a massive $213 million strategy sale. It successfully cleared that specific overhang, meaning that big block of sellers, but then it completely failed to break the 64K barrier.
Wow.
The structural diagnosis here is severe demand thinness. It's not a total collapse, but the momentum is demonstrably fragile. It's like a runner hitting a wall. They aren't collapsing on the track, but they absolutely cannot sprint any faster today.
Let's pull that apart, because on the surface, that seems contradictory. What does that actually look like day to day? Because, shouldn't absorbing a $213 million sell wall be interpreted as a massive sign of strength? Why are we reading a stall right after clearing an overhang as a signal of thin demand that an allocator should worry about?
It's a great question. It comes down to the mechanics of momentum. It's like trying to punch through a concrete ceiling where every single inch costs $50 million. Yes, the buyers stepped up to keep the floor from falling out, but in doing so, it completely drained all the kinetic energy needed for a breakout.
So it's a matter of capital exhaustion.
Precisely. In a healthy market environment, absorbing a sale of that size should just be a temporary speed bump. The fact that the buyers were completely exhausted at exactly $64,000 tells you the underlying bid depth, the amount of waiting buyers, just isn't there.
It's absorption without continuation.
Exactly. Demand is purely reactive right now.
Which means the next major market sell order won't hit a wall of buyers. It'll just hit an air pocket, and the price will cascade downward.
That is the exact systemic risk your macro overlay needs to account for over the next 48 hours. So, to synthesize these conflicting signals into actionable intelligence for your committee, here is the one clear time-box directive for this week.
Well, let's hear it.
Add ETH infrastructure exposure this week. The combination of JPMorgan's validated plumbing and BitMine's float compression creates an asymmetric setup to the upside, despite the manager risk we outlined. Second, hold your existing BTC allocations, but absolutely do not chase it above that $64,000 resistance level. The bid depth is simply too hollow, and you don't want to be the one providing exit liquidity.
That is a highly defensible posture. But I want to leave you with a final provocative thread to pull with your team. If traditional finance and corporate treasuries are actively compressing the Ethereum supply, treating it as critical infrastructure, while Bitcoin's momentum proves fundamentally too fragile to absorb major sales, how does that dynamic completely reprice the risk of maintaining a legacy Bitcoin-first allocation model heading into the rest of the quarter?
Right. If the mechanics have shifted, clinging to yesterday's macro overlay is the fastest way to invite decay. Definitely the question your committee needs to answer. That wraps our analysis of today's signals. Trust the data over the narrative, and we will catch you on the next deep dive.
That's your AION Investor Briefing. Stay informed every weekday. Subscribe now and download the AION app at aionpowerhouse.com.